Welcome to the Duck Dive, the show where we cut through the noise and deliver the insights you need to be truly well informed. Today, we're tackling something you've probably seen, especially if you've glanced at your traditional bank savings statement recently and felt a bit underwhelmed. We're talking about those really eye-popping numbers, 5%, maybe 8%, sometimes even higher advertised as, quote, risk-free APY on stablecoins. It really sounds almost too good to be true, doesn't it? I mean, in a world where a standard savings account might barely nudge past 1%, how are these digital assets possibly generating such significant returns?
And that feeling, that too good to be true feeling, is exactly what we need to explore today. Our mission in this deep dive is basically to pull back the curtain on this fascinating and, yeah, often quite opaque world of stablecoin yields. We're going to really try and get to the bottom of where that yield actually originates. Who are the real players involved? And crucially, what hidden risks might be lurking just beneath that very appealing surface? You'll get the full picture, the full stack everything from those centralized exchange earn programs to complex basis trades, how the stablecoin issuers themselves earn money on their reserves, and importantly, why those tempting incentives you see advertised are fundamentally different from actual interest.
Yeah, that's a huge one. We're going to arm you with a clear risk ladder, sort of a way to think about the different levels of danger and a practical due diligence checklist so you can navigate this space with, well, actual confidence. Forget the hopium, as they say in crypto. We're here to give you the clear, well-informed picture you really need. So let's dive right into the heart of the digital economy. Okay, so to really crack this mystery of the eye-popping stablecoin yield, we first have to get grounded in the basics. What is a stablecoin actually, and how does it even manage to stay stable in this notoriously volatile world of crypto?
Right. Well, at its core, a stablecoin is a type of cryptocurrency, but it's specifically designed to maintain a stable value. Think of it like a digital anchor in the often stormy seas of the crypto market. And they typically achieve this stability by pegging their price to some kind of reserve asset. Most commonly, that's a stable fiat currency like the US dollar. Now, it's really important to understand that stablecoins are not the same as central bank digital currencies, or CBDCs. CBDCs are issued and backed directly by central banks. They're a direct claim on a government. Stablecoins, on the other hand, are issued by private companies. And when you look at the market today, it's staggering. Over 90% of all stablecoins are currently pegged to the US dollar. That makes them a huge digital extension of dollar dominance.
Wow, over 90%. That's colossal when you think about it. So who are the big players actually building and driving this digital dollar infrastructure?
Well, in terms of market leadership, Tether, which you'll know as USDT, is currently leading the pack. It's got a market cap around $156 billion as of June this year, just consistently growing. Right behind them, you've got Circle with USDC. They're nearing, I think, about $58.6 billion market cap, especially after Circle's recent public debut. That brought a whole new level of scrutiny and, transparency. And it's not just those two giants, right? We're seeing others emerge. It's exactly. There are other significant players. You've got PayPal USD or PYUSD, which is issued by Paxos. That's a big name entering the space. And then there are more niche but still really important ones like Agora's AUSD. That one's interesting because it's specifically backed by tokenized US Treasury bills. So basically, it's backed by digital representations of government debt. It offers a potentially very direct, very secure way to earn yield from a traditional financial instrument wrapped in a crypto token.
Okay, so they started out as a way to manage volatility in crypto trading. How did they evolve?
Yeah, initially, back around 2014, they emerged mostly as a practical tool for crypto investors. If you were trading Bitcoin or something highly volatile, you could quickly swap into a stablecoin to sort of park your money during wild market swings, avoiding those rapid price changes. Then their use quickly expanded, mostly to just facilitate buying and selling other crypto assets on exchanges more efficiently.
But that was really just the beginning, wasn't it? Their modern uses have gone way beyond just crypto trading. They seem to be unlocking all sorts of new efficiencies.
Oh, absolutely. Take cross-border payments, for instance. If you've ever had to send money internationally using the traditional SWIFT system, well, it can be agonizingly slow and pretty expensive.
Ugh, tell me about it. Those fees.
Exactly. We're talking fees that can easily be $25, even $50 per transaction. And settlement times, 1 to 3 business days, sometimes even longer, depending on time zones and how many banks are involved. It feels archaic.
Yeah, like sending money via horse and carriage sometimes.
Right. Stablecoins, though, offer a completely different experience. Much faster, significantly cheaper. The payment rails are global, they work 247, and transactions often settle in minutes, sometimes seconds, for like a fraction of a cent in fees. You see big companies like SpaceX already using stablecoins for their treasury management, just moving money across borders with incredible efficiency. And Stripe, the big fintech player, they've basically said stablecoins are a much better way to do things for their tokenized payment initiatives. They see the potential to just revolutionize how businesses handle digital funds. That speed, that global reach, the low cost, it's incredibly appealing.
And it's not just about corporate efficiency, right? They're also fundamental within the crypto economy itself.
Totally. They're widely used as the critical settlement asset. Think about DeFi, decentralized finance, or just everyday trading on centralized crypto exchanges. Even in these emerging markets, for tokenized real-world assets. Stablecoins are like the common language, the neutral ground, allowing for immediate final settlement of trades, no waiting days for things to clear. And this efficiency is also making them really attractive for new institutional uses, like delivery versus payment, where you swap an asset for payment simultaneously, totally removing that counterparty risk.
That's powerful. And you mentioned financial inclusion earlier, too. How do they help there?
Yeah, this is a really crucial role, especially in regions facing economic instability. Think about countries where the local currency might be unreliable, or worse, suffering from hyperinflation. Stablecoins can be a lifeline. They offer access to the stability of the US dollar, and all you really need is a mobile phone and an internet connection. We've seen this play out really vividly in places like Venezuela, Argentina, where stablecoins have become this kind of new gray area dollar. They empower individuals, letting them preserve savings or just conduct daily business without constantly worrying about their money losing value overnight.
It really is quite remarkable providing that digital lifeline. And then there's this concept of programmable money. What does that mean in practice?
Right, so stablecoins aren't just digital cash, they're programmable. They can be built onto different blockchains and have logic embedded in them. This adds liquidity across chains and basically builds bridges between traditional fiat money and the Web3 ecosystem. For example, PayPal's PYUSD on the Solana blockchain uses something called Solana's token extensions. These are programmable features built right into the token's code. This allows for cool things like really granular control over who can send or receive payments, which could be useful for compliance, for example. And then you have tech like Layer 0, which can facilitate transfers of PYUSD between different chains like Solana and Ethereum, making everything much more interconnected and liquid. This programmability just opens up a whole universe of automated financial services.
Okay, so we get what they are and how they're being used, but the big question remains, how do they actually stay stable? Especially amid all the crypto chaos. That comes down to the backing, right? Which is absolutely fundamental.
It truly is. The mechanism at its core is pretty straightforward. The stablecoin issuers, the companies like Circle or Tether, they take the traditional currency they receive from customers, usually US dollars, and they invest that money. They invest it into safe, highly liquid assets. The main choice here is short-term US treasuries, which are considered among the safest investments in the world. This pool of assets, the reserve, is absolutely critical because it directly backs every single stablecoin they've issued. It ensures that if you, as a holder, want to redeem your stablecoin, say get your dollar back, they have the actual traditional currency readily available to give you. Circle, for example, makes a big point of saying its USDC reserve is held in segregated accounts, kept totally separate, solely for the benefit of USDC holders. And crucially, they state it cannot be used for Circle's own corporate expenses or operations. That segregation is a vital layer of protection for building trust.
That segregation is key. And here's where we hit a really significant difference from traditional banking, right? This is often a big aha moment for people. Stablecoin issuers, at least the non-bank ones, under rules like the Genius Act in the US, they cannot do fractional reserve banking.
Exactly. This is a massive distinction. Traditional banks, as we know, operate on a fractional reserve system. They only keep a fraction of deposits on hand and lend out the rest. Stablecoin issuers under this new regulatory framework are legally mandated to maintain 100% backing, 1-to-1. And it has to be with what are considered super safe reserve assets, like actual cash or very short-term government treasuries. This full backing is designed to ensure they can always meet every redemption request, even if there's a run where everyone tries to redeem at once. So if you come asking for your dollar back for your stablecoin, they must have that dollar available. It makes them fundamentally different from a commercial bank, which, by design, couldn't handle all depositors withdrawing simultaneously. That 100% backing is the bedrock.
And to make sure that 100% backing is actually real and maintained, transparency and regular audits are obviously key.
Absolutely essential. We're seeing a growing emphasis on proof of reserves. where issuers publicly demonstrate, often through third-party attestations, that their reserves genuinely match the amount of stablecoins circulating. For instance, Tether's CEO mentioned they're planning an auditing initiative for March 2025 to bolster confidence further. And over in Europe, the big MiCAR regulation already mandates independent audits of these reserve assets every 6 months. This kind of rigorous external scrutiny is just vital for ensuring stability and preventing the kind of blowups we've seen with less transparent crypto projects in the past. It really is all about verifiable trust.
Okay, let's get to the juicy part now, the question that's on everyone's mind, the real heart of this deep dive, that eye-popping yield. You see these ads promising 5%, 8%, maybe more APY on your stablecoins, and it really begs the question, how is that even possible if, like we just discussed, the stablecoin itself doesn't inherently pay you interest just for holding it?
Yeah, this is the critical distinction. It's where a lot of misunderstandings happen. It's so important to understand that stablecoins, just as a digital asset sitting in your wallet, do not inherently offer interest. They don't magically generate yield on their own. The yield you see advertised, that 5%, whatever, it comes from platforms or protocols that are offering interest on your stablecoin holdings. Typically, they do this by taking those stablecoins you deposit with them and using them in various financial activities, very often lending them out to someone else. So it's not the stablecoin issuer like Circle or Tether paying you. It's a third-party platform using your stablecoins to generate a return and then sharing some of it with you.
Right, so it's not like holding a government bond where the bond itself pays you interest, or even like a traditional savings account where the bank uses your deposits for its lending and gives you a small cut. It's much more active. It's like you're taking your stablecoin and deliberately lending it out through some separate program or protocol.
Precisely. And in fact, European regulations under MiCAR actually explicitly state that issuers of these asset reference tokens and the crypto asset service providers should not grant interest to holders just based on how long they hold the tokens. This was a deliberate policy choice. They wanted to reduce the risk of stablecoins being seen purely as a store of value, directly competing with traditional bank deposits.
And this often leads to confusion because the issuers themselves are earning yield on their reserves, right?
Yes, exactly. That's a common point of confusion. Stablecoin issuers like Circle, they hold billions in reserves, mostly in things like U.S. Treasuries. And right now, Treasuries are paying decent yield. The 10-year Treasury was recently around 4.4%. Hong Kong EF bills were over 4% back in March. So the issuers are earning significant income on those reserves. But generally speaking, that yield is retained by the issuer. They use it to cover their operating costs, pay salaries, maintain the technology, ensure solvency, and ideally generate profit for their business. It's not typically passed directly through to you, the stablecoin holder, as interest. So when you see that 5 Prinels APY advertised somewhere, that money isn't coming magically from Tether or Circle's reserves flowing to you. It's coming from something else entirely. It's generated by how your stablecoins are being actively put to work by the specific platform you're using.
Okay, so if the issuers aren't paying us directly, let's really unravel this yield map. How do these platforms generate returns for you? First up, probably the most common for beginners, CEX earn programs. CEX meaning centralized exchange.
Yes, exactly. Platforms like Gemini, Kraken, Binance, many others, they offer these earn or savings type programs. They promise to generate yield on your stablecoins if you deposit them there. The way this usually works is the exchange acts as a central intermediary, a bit like a bank, really. They take the stablecoins you deposit into their earn program, and they lend them out to other users on their platform. Now, who are these borrowers? Often they're traders using the stablecoins for activities like margin trading or, more commonly, highly leveraged derivatives trading. They need to borrow capital to amplify their bets. For example, Gemini recently added a bunch of altcoins like Doge, Shiba Inu, Solana as cross-collateral for derivatives. That means traders can borrow stablecoins against these volatile assets to potentially make bigger gains or losses. So the exchange collects interest from these borrowers, often at a pretty high rate because the borrowing is risky, and then they pass a portion of that interest back to you as the yield you see. Your stablecoins are held in the exchange's custody, and they manage the whole lending process.
Got it. So the exchange is the middleman. Now, moving into the decentralized world, we have DeFi lending protocols. This is where things get, well, more crypto native, let's say. No company intermediary, just code.
It's exactly. In decentralized finance, or DeFi, you can lend your stablecoins directly to protocols like APY or Compound. These are some of the biggest names. Here, the lender, that's you and the borrower, interact directly through smart contracts. These are pieces of code running transparently on a blockchain, ideally audited to ensure they work correctly. They replace the need for a traditional bank or exchange. You deposit your stablecoins into a liquidity pool within the protocol. Think of it like a big pot of money managed by the code. In return for providing that liquidity, you start earning yield. That yield comes directly from borrowers who pay interest to take out loans from that same pool of assets. And why are they borrowing? Often for similar reasons as on CEX's leverage trading, funding other DeFi strategies, maybe yield farming somewhere else. The interest rates in these DeFi protocols are usually quite dynamic. They fluctuate automatically based purely on supply and demand within that specific pool, all governed by the protocol's algorithm. If lots of people want to borrow USDC on APY, the rate goes up. If lots of people deposit USDC, the rate goes down. It's a real-time market.
Okay, that makes sense. Now let's get into some of the more maybe complex or even mysterious strategies you hear about that generate stablecoin yield. Things like perpetual funding, often linked with basis trades. This sounds pretty technical. This might be a real aha moment for listeners about where some of that high yield really comes from.
Yeah, it can definitely sound daunting, but the core idea is actually quite clever, though complex to execute. So, perpetuals, or perpetual futures, are a type of crypto futures contract. But unlike traditional futures, they don't have an expiry date. They just trade continuously, forever, in theory. A basis trade is a strategy that aims to profit from the price difference, the basis between the spot price of a cryptocurrency, like Bitcoin right now, and its perpetual futures price on an exchange. Often the futures price trades slightly higher than the spot price, especially in bull markets. So professional traders will typically go long the spot asset, meaning they buy Bitcoin directly, and at the same time they go short the perpetual future, meaning they bet on its price falling relative to spot, or simply hedge their spot position. They're essentially arbitraging that small price difference, the basis. Now, where do your stablecoins come in? They're often used to fund these positions, particularly the collateral needed for the short futures position. And the aha moment here, as you said, is that the yield you earn in this scenario doesn't come from traditional interest like a loan. It primarily comes from something called the funding rate.
Ah, the funding rate. Okay, what exactly is that? How does it generate yield?
Think of the funding rate as a small payment that's regularly exchanged between the traders holding long positions and those holding short positions in these perpetual futures contracts. It usually happens every 8 hours, sometimes more frequently. Its main purpose is to act like an anchor, keeping the perpetual contract's price closely tied to the underlying spot price. If the perpetual's price is trading higher than the spot price, which is common when the market is bullish and everyone wants to go long, then the traders who are long have to pay a fee to the traders who are short. Conversely, if the perpetual trades below spot, the shorts pay the longs. So when the market is generally optimistic and lots of traders are piling into long positions, this funding rate can become significantly positive. This means the shorts, often these sophisticated market makers or hedge funds running basis trades, receive this funding payment continuously. Your stablecoins, when lent out perhaps through an earn program or directly to these trading firms, are essentially providing the capital that powers these complex, relatively low risk, for the pros executing them, arbitrage strategies.
You, the stablecoin lender, get a cut of that funding rate payment for providing the necessary liquidity that makes these high-frequency continuous trades possible. It's a very different source of yield than a bank deposit, and it's a major engine behind some of the higher stablecoin yields you see, especially from platforms catering to professional traders.
Wow, okay. So it's basically profiting from a market mechanism designed to keep prices aligned, funded by traders' optimism or pessimism, and stablecoins provide the fuel. That really puts a different spin on it. What about market maker loans? How do they fit into this yield picture?
Market makers are absolutely essential for any healthy liquid market, whether it's stocks or crypto. They provide liquidity on exchanges by constantly placing both buy orders, bids, and sell orders, asks for an asset. Their main goal is to profit from the tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. That's the bid-ask spread. Now, to do this effectively, especially in fast-moving crypto markets, they need significant amounts of capital readily available, often in stablecoins, so they can quickly fulfill orders on both sides without taking too much directional risk. So when you lend your stablecoins to a market maker, perhaps through a specialized lending platform, you're essentially providing them with this vital operational capital. In return for using your stablecoins to facilitate their trading activity, they share a portion of the earnings they make from capturing that bid-ask spread back with you as yield. It's another way to earn from the fundamental mechanics of keeping crypto markets efficient and liquid. And it's another avenue where professional trading firms can generate yield that gets passed back to stablecoin lenders.
Got it. And finally, let's tackle a really popular, but as you said earlier, often misunderstood source of apparent yield in DeFi. Liquidity mining or just incentives. This is where that phrase incentives are not interest really hits home, right? And it seems critical for listeners to grasp this difference.
Oh, absolutely critical. This is perhaps where the advertised yield can be the most misleading, sometimes wildly so. With liquidity mining, the basic idea is you provide liquidity to a decentralized exchange, or DSEs. Typically, this involves depositing a pair of assets into a liquidity pool, often your stablecoin paired with another more volatile cryptocurrency, like Ether or some new DeFi token. In return for providing this liquidity, which allows other users to trade between those two assets in the pool, you usually earn a share of the trading fees generated by that pool whenever someone makes a swap. However, and here's the really crucial part, often a very significant portion, sometimes the vast majority, of the advertised APY doesn't come from those trading fees at all. Instead, it comes from newly issued governance tokens that are given out as rewards or incentives for providing liquidity. These are usually the native tokens of the DeFi protocol itself.
And this is where the big aha moment, or maybe the big warning sign, comes in. The value of these reward tokens can be incredibly volatile, right? They are not a guaranteed return on your stablecoin capital itself.
Precisely. Spot on. Imagine you see an advertised APY of, say, 100%, maybe even 500% from some new liquidity mining program. It looks amazing. So you deposit your stablecoins, maybe paired with another token, and you start earning these shiny new governance tokens. The numbers on your dashboard look fantastic. Your yield seems astronomical. But then the price of that governance token, which is often a brand new, highly speculative asset with little utility beyond voting or future promises, suddenly crashes. Maybe drops 80% or 90% during a market downturn, or just because the initial hype fades. Suddenly, your actual yield, when you calculate it in real terms by converting those reward tokens back into stablecoins or dollars, is drastically lower than advertised. It might even be negative if the token you paired your stablecoin with also dropped in value. That's called impermanent loss, a whole other risk. This is the key insight. That sky-high APY you saw was largely a mirage created by the temporary high value of a speculative reward token. It effectively masked the true underlying risk and the actual sustainable return on your stablecoins.
That made the whole proposition look much safer and more profitable than it really was. So whenever you see those crazy high APYs advertised, especially from liquidity mining, you absolutely have to remember, incentives are not interest. They are speculative rewards, and their value can vanish very quickly.
Okay, so we've mapped out the various ways platforms generate that yield. Now, we need to pivot to the less exciting, but absolutely essential part of this deep dive, the risks. That tempting risk-free label we talked about at the start is definitely misleading, often dangerously so. We need to understand exactly what can go wrong when you're chasing these stablecoin yields. Let's climb what we can call the risk ladder, starting maybe with the most common one, custodial risk.
Yeah, custodial risk is fundamental, especially when your stablecoins aren't in your own self-custody wallet, but are instead held on a centralized exchange or some lending platform, like those CEX Earn programs we discussed. In that scenario, you are literally entrusting that third party with your assets. You don't technically hold the keys anymore. They do. So your safety relies entirely on their security practices, their internal controls, their operational resilience, and ultimately, their overall financial health. A major hack of the exchange, or even just gross internal mismanagement or fraud, as we tragically saw with the collapse of FTX, can lead to catastrophic, unrecoverable losses for users who held funds on the platform. So for any platform, or even a bank supporting stablecoins, having truly robust cybersecurity is absolutely non-negotiable. This goes beyond just firewalls. It includes having really strong standard operating procedures, or SOPs, for every single payment activity. Think clear, documented steps for handling deposits, initiating payouts, rigorous address verification processes, constant reconciliation to ensure customer balances always match the actual holdings.
So it's not just about external hackers, but also internal processes and preventing mistakes or fraud.
Precisely. You need things like dual control, meaning two people have to sign off on critical actions, and multi-person approvals for large transactions. Whitelisting approved withdrawal addresses is a simple but effective control to prevent funds being sent to scammers. And end-to-end reconciliation is vital, making sure the stablecoins the platform says it holds for customers actually matches the balances on the blockchain and in their internal ledgers. Critically, good platforms should also perform regular stress tests. They should simulate crisis scenarios, like a sudden massive surge in withdrawal requests or a failure of a key third-party system, to identify any bottlenecks or weaknesses before a real crisis hits. And they need to do rigorous due diligence on any third-party service providers they rely on, like custody technology vendors or blockchain node providers, to ensure those partners also have high uptime and strong incident response plans. Even the stablecoin issuers themselves, despite aiming for 100% reserves, still face operational risks. Circle, for instance, makes it clear that while the USDC reserve is segregated, in the extremely unlikely event of their own corporate bankruptcy, the protection of those reserves ultimately relies on that segregation holding up legally. Backed by Circle's own corporate resources, they mentioned having over $800 million in cash and ongoing profitability standing behind their obligations. So while the risk is heavily mitigated for top issuers, operational risk always exists.
Okay, next rung up the ladder. Smart contract risk. This one is particularly relevant in the DeFi world, where the code itself acts as the custodian and intermediary.
That's right. In decentralized finance, when you deposit your stablecoins into a lending protocol like AV or Compound or liquidity pool on a day X, your funds are locked into smart contracts running on a blockchain. Now, these contracts are designed to be immutable, unchangeable, and transparent, which are key benefits. But they are still fundamentally pieces of code written by humans. And like any complex software, there's always an inherent risk of bugs, unforeseen exploits, or even a deliberately inserted malicious backdoors. Think of it like finding a critical vulnerability in your online banking software, but potentially with less recourse. The Maker protocol, for example, which issues the Day stablecoin, another major one, though it works differently, constantly emphasizes the absolute necessity of rigorous, independent technical auditing. They need to ensure their complex system, the Sky protocol, functions exactly as intended and is free from any exploitable flaws that hackers could target. These audits by reputable security firms are critical for identifying vulnerabilities before they cause massive losses.
And sometimes, paradoxically, to mitigate these smart contract risks, developers build in centralized controls, even within supposedly decentralized systems. That might surprise some people.
It might, but it's often a pragmatic reality. Some DeFi protocols and even some tokenized deposit systems being explored by banks incorporate safeguards like pause functions or circuit breakers. These are essentially emergency brakes or kill switches that designated administrators, often the core development team or a governance body, can trigger. They can temporarily halt all or part of the protocol's operations, pausing deposits, withdrawals, liquidations if they detect extreme market conditions, a major bug, or a suspected exploit in progress. Now, clearly, this introduces an element of centralization and trust in those administrators. But the argument is that it provides a crucial last line of defense against a catastrophic failure that could drain the entire protocol. It's a trade-off developers make between pure decentralization and practical risk management in volatile, complex systems.
Okay, now for perhaps one of the most feared risks, something that strikes at the very core of the stable promise, depeg risk. This is where the stablecoin utterly fails to hold its value.
Yeah, depeg risk is exactly what it sounds like. The risk that a stablecoin loses its peg to its underlying asset, usually the US dollar. Instead of trading at $1, it might start trading significantly below that, or sometimes even slightly above. Now, this risk is particularly pronounced and is historically proven absolutely catastrophic for what are known as algorithmic stablecoins. These are the types that, unlike the asset-backed ones like USDC or USDT, do not rely on holding 100% cash or treasury reserves. Instead, they try to maintain their $1 peg using complex algorithms and financial incentives, often involving automatically minting or burning other related volatile cryptocurrencies to try and balance supply and demand. The fundamental flaw, which we've seen exploited time and again, is that these systems rely heavily on market participants constantly acting rationally and arbitraging the price back to $1. But during times of extreme market stress or panic, those arbitrage mechanisms can break down completely. The incentives fail, confidence evaporates, and the whole thing can unravel incredibly quickly.
And we saw a truly vivid, incredibly painful example of this with the Terra Luna ecosystem back in May 2022. It really became the ultimate cautionary tale for algorithmic designs.
Absolutely. Terra Luna is now the poster child for algorithmic stablecoin failure. Its stablecoin, UST, was designed to maintain its $1 peg through this complex burn and mint mechanism with its sister token, Luna. It seemed to work for a while, attracting billions in deposits with high advertised yields, but when market conditions turned volatile, someone or something initiated massive selling pressure on UST. The peg started to slip. As confidence wavered, more people tried to redeem UST for Luna, as the mechanism allowed, which flooded the market with Luna, crashing its price. This, in turn, further undermined confidence in UST's backing, causing more selling. It triggered what's now famously known as a death spiral. The system's algorithmic mechanisms simply couldn't cope with the sheer selling pressure. UST plummeted, falling from $1 to well below 50 cents, eventually becoming almost worthless. The result was an estimated $45 billion wiped out in a matter of days, and the entire ecosystem basically collapsed, halting its blockchain.
This event just profoundly underscored why many experts believe purely algorithmic stablecoins without robust external collateral are inherently fragile and essentially built to fail under sufficient stress. It highlighted by painful contrast the critical importance of having actual, transparent, liquid asset-backed reserves if you want a stablecoin to have a fighting chance of actually remaining stable.
And in that kind of depeg scenario, it becomes this desperate exit game theory, doesn't it? Everyone just races to get their money out, redeem their stable coins before the reserves run out or the whole system collapses. It's a terrifying test of whether any recovery mechanisms can possibly function under that kind of extreme stress.
This leads us to another critical risk: rehypothecation. What exactly is that in this context?
Right, rehypothecation risk is another important one, and it's often misunderstood, especially in relation to stablecoins themselves versus the platforms offering yield. As we established earlier, the major regulated stablecoin issuers, particularly under frameworks like the Genius Act, are generally not permitted to engage in fractional reserve banking or to lend out their customer reserves. They have that strict 100% backing requirement. However, the risk of rehypothecation, which basically means reusing collateral that has been posted by a client, like lending it out again, arises not usually from the stablecoin issue itself, but from the platforms that you deposit your stablecoins with to earn that yield. Okay. So the underlying stablecoin itself might be fully backed by the issuer, but the platform I gave it to, the CEX Earn program or the DeFi lender, they might be lending it out multiple times or using it in risky ways I don't see.
Exactly. That's the core issue. These platforms offering yield, whether centralized or decentralized, might rehypothecate your stablecoins. They might lend them out again to other borrowers, perhaps hedge funds or other trading firms. Or they might use your deposited stablecoins as collateral themselves for their own leveraged trading or investment strategies, potentially without full transparency to you, the original depositor. This creates significant counterparty risk. If that platform goes bankrupt, like Celsius or Voyager did, or if one of its major borrowers defaults, your stablecoins, which you thought were safely earning yield, could be tied up in bankruptcy proceedings or lost altogether. This happens even if the underlying stablecoin itself, like USDC, remains fully backed and operational by its issuer, Circle. This is a really key and often overlooked difference. Simply holding a stablecoin in your own wallet carries the issuer risk and depeg risk, but actively lending it out on a platform to earn yield introduces a whole new layer of counterparty risk and rehypothecation risk associated with that specific platform's solvency and practices. You're taking on their creditworthiness.
That's a crucial distinction. Then we have regulatory risk, which feels like a constant shadow hanging over the crypto space, maybe especially for something as foundational and potentially disruptive as stablecoins.
Indeed. Regulatory risk is huge and constantly shifting. Governments worldwide are grappling with how to handle stablecoins. In the U.S., for example, agencies like the Treasury's Office of Foreign Assets Control, OVAC, are very actively working to disrupt the use of stablecoins for illicit purposes, particularly sanctions evasion. Now, interestingly, the inherent transparency of most blockchains can actually help law enforcement trace illicit funds, and stablecoin issuers often have the technical capability to freeze funds associated with sanctioned addresses right on the blockchain itself. But there's still a continuous push from regulators for enhanced authorities to go after non-compliant issuers or platforms facilitating illicit finance. OFAC's rules, like the complex 50% rule, which states that any entity owned 50% or more by a sanctioned person is also considered sanctioned, highlight the need for incredibly rigorous compliance checks by everyone interacting with stablecoins. It's an ongoing high-stakes game of cat and mouse.
And the regulatory landscape isn't just about illicit finance, right? It's also about consumer protection, financial stability, and the fact that different countries are taking different approaches, which creates its own problems.
That's a key point. The landscape is incredibly fragmented globally. You have Europe moving ahead with its comprehensive MiCAR framework, which we mentioned earlier. It applies from June 30, 2024 for stablecoins and aims for that same activities, same risks, same rules principle. MiCAR imposes really stringent conditions, especially for stablecoins deemed significant, those with large user bases or market caps. These face much higher capital buffers, stricter liquidity rules, more intense supervision, almost like mini banks. But the U.S. is still developing its federal framework, other countries are doing their own things, and this lack of global consistency is a major concern. It could lead to fragmentation where rules differ significantly across borders. This, in turn, could foster instability as activity flows to the least regulated jurisdictions. That's regulatory arbitrage. And as we touched on, It could have geopolitical consequences too, potentially disadvantaging regions that don't have strong domestic stablecoin options.
And finally, a risk that's always present, especially when money seems easy to make. Good old-fashioned fraud and scams.
Yes. Unfortunately, wherever there's hype and the promise of high returns, scammers are sure to follow. With bullish signs potentially returning to the crypto market heading into 2025, we have to expect an increased likelihood of scams and outright frauds targeting stablecoin holders and yield seekers. These can range from fake investment platforms promising impossible returns to phishing attacks trying to steal your private keys or trick you into sending funds to malicious addresses. Regulators globally are aware of this and are expected to take increasingly aggressive and coordinated actions to combat what many see as an online fraud epidemic, similar to how they tackled ransomware threats. The good news, perhaps, is that the tools for fighting back are improving. Blockchain forensics technology is rapidly advancing, allowing for more automated tracing of stolen digital assets, a process that used to be incredibly manual and slow. But ultimately, user vigilance remains the first and best line of defense. If an offer sounds too good to be true, it almost certainly is.
Okay, that's a sobering rundown of the risks. So with all of that on the table, how can you, as someone holding stablecoins or considering chasing these yields, actually protect yourself? We mentioned putting together a due diligence checklist. What should people look for?
Right? Having a checklist is crucial for navigating this. First and foremost, always look for proof of reserves. This means checking if the stablecoin issuer, and ideally the platform offering yield too, provides transparent, easily verifiable evidence that the assets backing the stablecoins or the assets backing the yield program actually exist and match the liabilities. This information should be readily available on their website, updated frequently, ideally daily or weekly, and ideally attested to or audited by a reputable, independent third party. If you can't find clear proof of reserves or if it's confusing and opaque, that should be a major red flag.
Okay, proof of reserves first. What's second?
Second, look for independent audits. Don't just trust their marketing materials. Look for audits conducted by well-known, reputable accounting or security firms. These audits should ideally cover not just the composition and sufficiency of the reserves, but also the financial health and operational security of both the stablecoin issuer and the platform offering the yield. As we noted, MiCA in Europe mandates independent reserve audits every 6 months. Look for similar commitments to regular independent verification. It adds a critical layer of trust and accountability, much like financial audits for public companies.
Makes sense. Third,
Carefully scrutinize the disclosures and terms and conditions. Before you deposit anything into a yield-bearing product, you need to understand exactly what you're signing up for. What are the underlying strategies being used to generate the yield? Are they lending your stablecoins out? If so, to whom? Are they using leverage? Are they engaging in basis trades? Who are the counterparties involved? What are the specific risks involved beyond just holding the stablecoin itself? Things like liquidation risk, platform insolvency risk, smart contract risk for that specific protocol. The more detailed, clear, and transparent the disclosures are about the sources of yield and the associated risks, the better equipped you are to make an informed decision. If the explanations are vague or focus only on the potential upside, proceed with extreme caution.
okay, disclosures. Fourth point on the checklist.
Fourth, consider concentration risk. Is the yield product you're looking at overly exposed to one specific thing? For example, does it rely heavily on yield from a single DeFi protocol? Is a large portion of the lent-out fund going to a single borrower or market maker? Is the stablecoin itself heavily reliant on reserves held at just one bank? A diversified approach is generally safer. MiCA, for instance, specifically requires significant stablecoins to manage market risk, credit risk, and concentration risk in their reserves. Applying that same logic to yield products makes sense. Putting all your eggs in one basket, even if it's a stablecoin yield basket, can be incredibly risky if that single point of failure, be it a protocol, a counterparty, or an asset, runs into trouble. Look for diversification where possible.
Good point. And finally,
understand the regulatory status of everyone involved. Do some research into the regulatory environment of both the stablecoin issuer and the platform offering the yield. Are they licensed to operate in reputable jurisdictions? Do they publicly state their compliance with key regulations like anti-money laundering, AML, and counter-terrorist financing, CTF standards? Knowing their regulatory standing and their approach to compliance can give you a clearer picture of their maturity, their commitment to operating responsibly, and their overall risk management posture. Generally, entities operating under stricter regulatory oversight tend to be more stable and reliable, although it's no guarantee.
This checklist, proof of reserves, audits, disclosures, concentration, and regulatory status, gives you a solid framework for asking the right questions and distinguishing potentially legitimate opportunities from propositions that carry excessive or hidden risks.
So we've dissected the mechanics, unpacked the yield sources, and confronted the risks. Now let's zoom out again and look at the bigger picture, the evolving regulatory landscape and what the future might hold for stablecoins. Let's start with the US. There seems to be a lot of talk about potential shifts in regulation and how that impacts the dollar's role.
Yeah, the regulatory environment in the U.S. is definitely in flux, and there's a lot of anticipation, perhaps optimism, within the crypto industry about potential changes. With an incoming Trump administration, the expectation of a new head at the SEC, and potentially a Republican majority Congress, many believe we'll see a more permissive stance towards banks and traditional financial institutions getting involved with crypto assets. Specifically, there's a strong expectation that Staff Accounting Bulletin 121, or SAB 121, might be repealed or significantly revised. SAB 121 has made it very difficult and capital-intensive for banks to custody crypto assets like stablecoins, effectively keeping many on the sidelines. Removing that barrier could be huge. Also, appointments to key regulatory bodies like the OCC, Office of the Control of the Currency, and the FDIC are expected to be more favorable towards banks engaging with crypto, perhaps echoing the approach under Brian Brooks during the first Trump administration, who actively encouraged banks to explore crypto services under proper controls.
That does sound like it could be a significant shift, potentially opening the door for much greater institutional involvement and maybe legitimization of the space. And the Genius Act we mentioned earlier also fits into this, right?
Absolutely. The passage of the Genius Act is a really key piece of recent legislation. It's specifically designed to bring much-needed regulatory clarity to the stablecoin market in the U.S. And this newfound clarity is already seen as encouraging more traditional financial institutions to engage with stablecoins and other digital assets with greater confidence, knowing there's a clearer rulebook. Many policymakers and industry folks view this type of legislation as a strategic move. They see it as helping to ensure the U.S. dollar remains dominant in the emerging digital financial system, making sure that the future of digital money remains anchored, at least in large part, to the dollar.
The White House also put out a digital assets report recently. What were some of its key recommendations regarding financial crime and how regulation should adapt?
Yeah, that report laid out a pretty comprehensive vision. It called for modernizing the Bank Secrecy Act, BSA, the main U.S. anti-money laundering law, to make sure it remains effective for digital assets. It urged Treasury and other regulators to figure out how AML and CTF obligations could be applied more consistently across the board, not just to centralized exchanges, but also potentially to aspects of the decentralized finance, DeFi ecosystem, and even self-custody situations, acknowledging that illicit actors exploit any gaps. While it didn't outright recommend bringing all of DeFi under the BSA, it did encourage Treasury to explore creating new categories of BSA-regulated financial institutions specifically designed for the unique roles in the digital asset world. This could potentially include entities like cross-chain bridge operators, network validators, or even the developers of front-end interfaces, depending on their specific functions and risks. The report also pushed for expanding anti-tip-off rules, which prevent criminals from being alerted to investigations, to cover crypto businesses, and crucially, updating asset forfeiture laws. This would make it easier for law enforcement to seize illicit funds held in crypto wallets, even if they can't trace the specific origin of every single coin, bringing the rules more in line with how illicit cash is handled today.
So really a broad push for more consistent and comprehensive oversight, trying to close loopholes. But even if the overall administration becomes more pro-crypto, it sounds like OFAC, the Treasury sanctions arm, won't be easing up on illicit finance concerns.
Not at all. That's a really important point. Regardless of the broader political winds regarding crypto innovation, the U.S. Treasury, particularly OFAC, is expected to remain very aggressive in targeting the use of stablecoins for sanctions, evasion, terrorist financing, and other illicit activities. They may even seek stronger legal authorities from Congress to go after stablecoin issuers or platforms they deem complicit, even if unintentionally, in facilitating these activities. And it's worth remembering, as OFAC itself has pointed out, the inherent transparency of public blockchains can actually be a double-edged sword for criminals. It provides an immutable public ledger that investigators can analyze, often revealing the flow of funds in ways that traditional finance cannot. Plus, the ability of issuers to freeze funds on-chain is a powerful enforcement tool. So the scrutiny on illicit use is definitely not going away and may even intensify.
Okay, shifting focus beyond the U.S., how are other major players, particularly Europe, approaching stablecoin regulation? Is it a unified front, Or are we seeing different paths emerge?
Europe has definitely been a front-runner here with its comprehensive MiCAR regulation. As we mentioned, the rules for stablecoins, asset reference tokens, and e-money tokens became applicable on June 30, 2024. MiCAR is really guided by those core principles of same activities, same risks, same rules, trying to level the playing field with traditional finance. And it aims for technology neutrality, so the rules apply regardless of the specific blockchain or tech used. It imposes quite stringent conditions, especially on stablecoins that are classified as significant. This designation depends on factors like having a large EU customer base, a high market capitalization, or processing a high volume of transactions. These significant stablecoins face notably higher capital requirements, much stricter liquidity management policies, and more intensive ongoing supervision by European authorities, making them operate much more like traditional regulated financial institutions.
So Europe is really trying to build a robust framework. But this brings up those concerns about global fragmentation again. What are the potential downsides if the US, Europe, Asia, etc., all end up with significantly different rules?
Yeah, that fragmentation concern is very real and widely discussed. Without stronger global coordination and harmonization of stablecoin rules, the worry is that this patchwork approach will persist. This could lead to instability, as businesses might engage in regulatory arbitrage, just setting up shop in whichever jurisdiction has the lightest rules. Illicit actors definitely exploit these seams. There are also potential macroeconomic and geopolitical consequences. The European Central Bank, for example, has openly worried that if US dollar-pegged stablecoins become dominant globally, it could give the U.S. significant strategic advantages, like potentially allowing it to finance its national debt more easily or exert greater influence through controlling the digital currency rails. Conversely, regions like Europe could face higher borrowing costs for their own governments and businesses, reduced effectiveness of their own monetary policy, and increased geopolitical dependency if their citizens and companies rely heavily on foreign stablecoins. This really underscores why many international bodies are pushing for stronger global coordination to avoid fueling instability and creating an uneven playing field.
That certainly makes a powerful case for developing non-dollar stablecoins then. Are we actually seeing significant traction there, or is the market still overwhelmingly dominated by the digital dollar?
We are definitely seeing growing interest and activity in non-dollar stablecoins, although the US dollar versions still dominate by market cap. But there's a clear appetite for diversification. Société Générale, the major French bank, launched its Euro-pegged stablecoin, ERCV. While its market cap isn't near USDC's yet, reaching $41.8 billion as you cited earlier feels like a typo, its existence demonstrates serious institutional interest in building euro-based digital rails. Self-correction. Checking the source again, the $41.08 likely refers to something else, perhaps total market cap or a different metric. ERCV itself is much smaller currently, but represents significant intent. We've also seen reports, perhaps less verifiable, about things like a ruble-pegged stablecoin, A785, allegedly transferring enormous volumes like $1 billion per day. While the exact figures and purpose might be debated, potentially linked to sanctions, evasion, or capital flight, the sheer reported volume, even if exaggerated, points to a significant demand for alternative financial channels outside the traditional dollar-dominated system.
It really showcases that stablecoins are having real-world impact, far beyond just enabling crypto trading. And they're meeting needs in various geopolitical and economic contexts, driving demand for non-dollar alternatives. It's a trend worth watching very closely.
Absolutely. So finally, let's talk about integration. How are stablecoins weaving themselves into the fabric of traditional finance, and what are some of the more cutting-edge innovations emerging that could really reshape our financial future?
We're seeing banks move beyond just observing. They're becoming increasingly active participants. They're getting involved in stablecoin development, issuance, custody, and integration into their existing services. They recognize they can play really meaningful roles. They can be facilitators of seamless fiat to stablecoin transfers. They can be trusted converters. And crucially, they can act as compliance partners, leveraging their decades of experience with regulation like AML and KYC. We already mentioned Société Générale launching stablecoins. Another great example is their plan for a USD-denominated stablecoin, USDCV, where they're partnering with a giant traditional custodian, Bank of New York Mellon, to hold the reserves. That's a major TradFi institution stepping right into the operational core of a stablecoin. And you see other major U.S. banks like PNC actively stating they're supporting clients who are interested in crypto, including stablecoins, on their platforms. It signals a much broader institutional embrace.
And it feels like stablecoins are really pushing the envelope on real-time payments, doesn't it? Transforming how quickly money can move.
Totally. They are a huge catalyst for the growth of real-time payment systems globally. For fintech companies like Stripe, Revolut, Robinhood, stablecoins offer a fundamentally much better way to do things, as Stripe put it. The ability to transfer value across borders almost instantly, 204/7, and at incredibly low cost is just a massive improvement over the old correspondent banking system. They offer immediate settlement finality and a level of transparency that traditional cross-border payments often lack. Many see them becoming the foundational rails for a new, global, instant payment infrastructure in the years ahead.
Now, what about this intriguing, maybe still slightly futuristic intersection of artificial intelligence and crypto? Are the big AI labs paying attention to crypto, or is the connection more subtle?
Yeah, it's an interesting area, though still quite nascent. For the most part, the major AI research labs, your OpenAIs, Google's, Anthropic needs, they seem laser-focused on the monumental task of advancing AI itself. Crypto doesn't appear to be a primary focus for them right now. The opportunities in pure AI are just so vast. However, you are seeing a growing number of crypto-native companies getting really interested in AI. They're exploring how crypto infrastructure, particularly things like stablecoins and smart contracts, could enable entirely new business models for the AI-driven internet. Imagine, for example, a system where every piece of data you contribute to training an AI model, every image you upload, every sentence you write is tracked on a blockchain, and you're automatically compensated with micropayments, perhaps in stablecoins, based on how valuable your contribution proves to be. Crypto could provide the rails for these kinds of granular automated attribution and payment systems. You might also see decentralized AI networks emerge, where computing power for training models is bought and sold peer-to-peer using crypto. We saw a small hint of this potential intersection with PayPal enabling its systems to support OpenAI, possibly for facilitating payments or managing credentials. It suggests these worlds, while largely separate now, are likely to become increasingly interlinked, with stablecoins potentially playing a key role in the economics of future AI systems.
Fascinating potential there. And finally, let's touch on that big picture concept from the Bank for International Settlements, the unified ledger vision. How does this tie into stablecoins and the potential future of the whole financial system?
This is a really ambitious long-term vision, but one that could fundamentally reshape how money and assets move. The BIS, which is like the central bank for central banks, envisions a future financial infrastructure based on a unified ledger. The idea is to integrate different forms of digital value, tokenized central bank money, CBDCs, tokenized commercial bank deposits, which could function like highly regulated stablecoins issued by banks, and even tokenized securities like government bonds, all onto a single shared programmable platform or network of platforms. This integration, they argue, could become the backbone of the future monetary system. It would streamline countless processes by eliminating the need for complex reconciliations between today's siloed financial ledgers. It could enable instantaneous settlement, atomic settlement, where the asset and the payment change hands simultaneously, and open the door for entirely new financial instruments and automated services through the programmability of everything on the ledger. Think of complex transactions bundled into a single instant operation.
Stablecoins, particularly in the form of tokenized commercial bank money or perhaps highly regulated e-money tokens, alongside tokenized traditional assets like T-bills, would likely be integral components of such a unified ledger, serving as the efficient, programmable units of value that facilitate these seamless transactions. It's a vision of a hyper-efficient, interconnected digital financial future, where much of the friction and delay in today's system simply melts away.
Wow, what a comprehensive journey we've taken today. We've really gone from the basics of stablecoins as digital anchors, delved deep into the often complex ways they generate yield, and confronted that whole web of risks and the ever-evolving regulations surrounding them. I think it's clear that the risk-free label, while definitely appealing, obscures a much more layered and nuanced reality. It's a complex ecosystem with diverse activities and very different approaches globally. It's certainly not as simple as putting money in a savings account.
Absolutely. And understanding these dynamics, I think, isn't just for hardcore crypto enthusiasts anymore. It's becoming increasingly vital for anyone navigating the broader financial landscape. Stablecoins are clearly evolving rapidly. They're moving from being a niche crypto tool to becoming a potentially integral part of digital finance, influencing everything from how we send money across borders to how institutions manage their treasuries, and maybe even how future AI economies function. They are genuinely a force shaping the future of money.
So as we wrap up, and as financial systems everywhere continue this rapid digital transformation, with traditional players increasingly embracing these new technologies, here's something to think about. If stablecoins offer such demonstrably efficient and accessible financial services, how might the continued divergence in regulatory approaches around the world, with Europe going one way, the US another, other regions perhaps lagging or taking unique paths, how might that divergence ultimately shape our interconnected digital economy? Will it catalyze innovation by allowing different models to flourish in different regions, or will it constrain progress, creating fragmentation, instability, and perhaps reinforcing existing geopolitical and economic divides? It's a huge question, one that will undoubtedly define the coming years, and its answer will have profound implications for all of us.